welcome back. If this is your first time here, my name is Diana Hoff, and this channel is dedicated to educating you on self-directed IRAs, what they are, how they work, and how to use them properly. Today, we're covering one of the most critical topics in self-directed IRA education, prohibited transactions. I'm going to walk you through real examples of transactions that violate IRS rules. The kinds of mistakes that can cost you not just one asset, but your entire IRA account. These are not hypotheticals. These are the types of scenarios that actually happen when people have the right intentions, but the wrong information. Stick with me through this one. It could save you a lot. And as always, Mountain West IRA provides educational content and administrative services. We're not your tax advisor, your attorney, or your financial planner. Everything in this video is for educational purposes only. So let's get into it. What is a prohibited transaction? Now, if you're already familiar with prohibited transactions and want to skip ahead, use the timestamps in the description below to go right to the examples. Let's start with the foundation. What is a prohibited transaction? Under Internal Revenue Code, Section 4975, you'll also hear this called IRC Section 495, same thing. A prohibited transaction is any improper use of your IRA by you or what the IRS calls a disqualified person. The entire framework exists to prevent self-dealing. The IRS wants to make sure that your IRA is being used for retirement purposes, not as a tool for your present-day personal or financial benefit. Now, you might be thinking, I would never intentionally cheat. I know. Most prohibited transactions do not come from bad intent. They come from not knowing where that line is. So let's draw that line clearly. First of all, who is a disqualified person? Before we get to the examples, you need to know who counts as a disqualified person because every prohibited transaction involves a disqualified person on one side or the other. So disqualified persons include you, the IRA account holder, your spouse, your children and grandchildren, and anyone married to them, your parents and grandparents, and anyone married to them, any fiduciary of your IRA, and any company or entity where you or one of those prohibited persons own 50% or more. Here is what is not on the list: cousins, friends, unrelated business partners. Those people can generally transact with your IRA. Just be sure to avoid indirect prohibited transactions. And we'll talk about those in just a moment. This distinction matters enormously when you're structuring deals. Knowing who is and isn't disqualified is the first filter every transaction needs to pass. Okay, time for some plain language examples. First, example 1, buying or selling with family. And this one actually trips up a lot of people. Your self-directed IRA cannot buy assets from disqualified persons, and it cannot sell assets to them either. Let's say you own a rental property and you want to move it into your IRA for tax advantage administration. You can't do it. Your IRA cannot buy it from you regardless of what you charge. What about buying from your parents? No. What about buying from your adult children? No. The transaction itself is a violation. Price does not fix it. Intent does not fix it. The relationship between the parties is what the rule is about. Now, your IRA can buy real estate from unrelated third parties, a seller on the open market, a wholesaler, a developer, something right off the MLS. You have no disqualifying relationships with them. That is fully permissible. The key is the relationship. Now, remember me talking about indirect prohibited transactions? You can buy from your cousin, but you cannot sell them your rental property so that your IRA can buy it. At the end of the day, you have still taken something you own and tried to get it into your IRA. You can't use someone else as a middle step to get around the rules. Even if your cousin is not a disqualified person, you still can't sell your rental property to them and then have your IRA buy it. Why? Because in substance, you are still trying to move property you personally own into your IRA. Indirect prohibited transaction. Basically, using another person as a buffer does not change the fact that the transaction would still be prohibited. Okay, example 2. Personal use of IRA-owned property. This one surprises people. Your self-directed IRA can own real estate, a rental property, a vacation home, a commercial building, all permissible as an asset class. But here's the rule that people miss. You cannot use it. Not for a vacation, not to store your belongings, not to stay while you supervise a renovation, not even for one night. You, your spouse, your kids, your parents, all of the people listed as disqualified people, none of you can personally use the property owned by your IRA. The moment you do, you have a prohibited transaction. The property must work exclusively for the benefit of the IRA, not for you, not for your family, for the account. If you want a vacation home you can actually use, that property belongs outside of the IRA. Okay, let's see. Example 3. Lending IRA funds to yourself. Private lending through a self-directed IRA is a popular and legitimate option. Your IRA can hold promissory notes, lend money to unrelated borrowers, and receive payments back into the account. But your IRA cannot lend to you. It cannot lend to your spouse. It cannot lend to your children or to your parents. The IRA is not your personal credit line. The moment those funds go to a disqualified person, regardless of how solid the repayment plan looks, you have a prohibited transaction. Lending must go to independent, unrelated third parties. This is when it's a legitimate option inside of your self-directed IRA. Okay, let's see. Example 4, getting paid for services on IRA assets. Example 4 might be one of the most counterintuitive. Let's say your IRA owns a rental property and you're a licensed plumber. The pipes need work. Can you do it yourself and charge the IRA your standard rate? No, that's a prohibited transaction. Even if your rate is competitively fair, even if you would charge the same to any other client, you personally cannot receive compensation from your own IRA for services. Full stop. This applies to contractors, property management, maintenance workers, and any other compensated role connected to IRA-owned assets. Your IRA must hire independent, unrelated professionals for everything. Keep yourself out of any paid function tied to IRA assets. Okay, let's see. Example 5, using IRA as collateral. This one catches people off guard. If you need a personal loan and you think, hey, I have a large IRA, maybe I can use it as collateral. Stop. That's a prohibited transaction. The moment you pledge IRA assets as security for a personal obligation, the IRS treats the pledged portion as a taxable distribution. You owe income taxes on that amount immediately. And if you're under 59 and a half, you likely owe the 10% early withdrawal penalty on top of that. No personal loan, no mortgage, no short-term arrangement justifies using your IRA as collateral. The rules are very clear. Consequences. Let's talk about what actually happens when a prohibited transaction is identified. The IRA is disqualified, not from the date the transaction was discovered, from January 1st of the year the violation occurred. The entire fair market value of the account is treated as a taxable distribution, not just the asset involved, the whole thing. You may face a 15% excise tax on the amount of the prohibited transaction. If you are under 59 and a half, a 10% early withdrawal penalty may also apply. This is not a slap on the wrist. For a large IRA, this could represent hundreds of thousands of dollars in immediate tax consequences. That is the weight of one prohibited transaction. And again, most of these happen not because someone tried to cheat, but because they didn't know the rules. So, what do you do with all this? First, know who is a disqualified person in your life. Build that list before any transaction. Second, never personally use IRA-owned assets. Perform compensated services on them, borrow from them, or pledge them as collateral. Third, before you execute any transaction that feels even slightly complex, novel, or unique, consult with a qualified tax attorney or CPA who knows IRS and IRA rules. This is really not optional. It's the smartest thing you can do. Mountain West IRA is your self-directed IRA administrator. We're here for education and administration. We process your transactions, maintain your records, and help you understand the framework. But we're not your advisor. For advice, consult your own qualified professionals. If you need help getting started, talk to us. We'll give you some questions that you can ask them. Visit mountainwestira.com to access our full educational resource library or to learn about opening a self-directed IRA. If this video was helpful, subscribe for more self-directed IRA education. You can call us at 866-377-3311. Or if you'd like to schedule a time to talk and ask your questions, go ahead and use the QR code in the corner. And as always, control your options, know your rules, and protect your account. We'll see you next time. Bye.